Hello everyone, this is Orhan. In this video, I'm going to talk about the second chapter of Financial Management book by Brigham and Houston. In this chapter, we will be covering financial markets and institutions. Let's start with this figure, which shows how the capital is transferred between savers and borrowers. In financial markets, we have savers and borrowers, and there's a link between those two. Here, we will cover how the funds are transferred between those two parties. There are two kinds of channels. The first channel is called direct finance, and the second channel is called indirect finance. Direct finance occurs when a business sells its stocks or bonds directly to savers. So say, for example, there's Apple here, and you want to buy Apple shares, so you are a saver and Apple is borrower. So if you buy their shares in the stock market, they are selling their shares directly to you without going through any type of financial institution. The business delivers its securities to savers who in return give the firm the money it needs. In indirect finance, you deposit your money to a bank and say this is Chase Bank, and that bank lends your money to Apple indirectly. You don't know to whom Chase is lending your money, and Apple does not know you are the depositor. Stocks and bonds, they are generally used here in direct finance, and deposits, they are generally used in indirect finance. Now let's define what a market is. A market is a venue where goods and services are exchanged, and a financial market is a place where individuals and organizations wanting to borrow funds are brought together with those having surplus of funds. So remember the previous graph, the figure, it was showing the structure of a financial market. There are different classifications. The first classification is physical assets versus financial assets. Physical asset markets are for products such as wheat, autos, real estate, clothes, etc. And financial asset markets generally deal with stocks and bonds. The other classification is money versus capital markets. Money markets are the markets for short-term, highly liquid debt securities. When we say short-term, we generally mean less than 1 year. And capital markets are higher than 1 year. So capital markets are the markets for intermediate or long term. So generally 1 to 10 year is defined as intermediate term. More than 10 years, let's say more than 10 years is called long term. So capital markets are dealing with both intermediate plus long term debts and corporate stocks. So stock market, for example, is a capital market, and then stocks are capital market instruments. An example to money market instrument is maybe 3-month government bond. And then comes primary versus secondary market. Primary markets are the markets in which corporations raise new capital. So the very first time institutions, companies are selling their stocks, their bonds, it's called the primary market. If you buy directly in the IPO, which is initial public offering, I will talk more about that soon. In IPO, for the very first time, when you are buying a stock, it's called primary market. If you are buying from somebody else, it's secondary market. Generally, most of the stocks we are buying are 90%, 95%. They are secondary market instruments just because we are buying it from people, not from the company directly. The last one I will talk here is called spot versus futures. Spot markets, when you buy the stock or bond directly now, and then you pay the money now, that's a spot market. A future market, you enter the contract in which you agree today to sell or buy tomorrow. So generally the agreement is made today. The transaction is generally going to happen tomorrow. For example, a farmer enters into a contract in which he agrees today to sell 5,000 bushels of soybeans 6 months from now at $9 per bushel. It's a future contract. In recent years, changing technology has created various innovations and has dramatically transformed the operational financial markets. And I'm going to give you 2 examples. The first one is HFT. It stands for high frequency trading. So changing technology has created a whole class of firms that use computer algorithms to buy and sell securities, and often at speeds of less than a second. So these trades are conducted by very high frequency trading firms, and they now represent a very significant fraction of the total trading volume in a given day. The other one is Bitcoin. Bitcoin is a new currency that was created at the end of 2008 by a person, seemingly a software developer, or who called himself Satoshi Nakamoto. So the money is digitally created and held. It's not like a banknote or coin. It's neither printed nor minted. You can see your balance on the computer only. So what makes Bitcoin different from our digital bank account is that this new money was to create a completely decentralized means of exchange, meaning that no central authority is needed for the issuance or control or the usage of the money. It's not issued by a government, rather it is mined by computers and the system rewards the miners. So in this chart, you see the Bitcoin prices in the last 1 year. Currently, it is priced at almost $50,000. You can see from the right axis here. And as you can see, there's a huge price volatility in Bitcoin. So it's a very risky investment. If we can change the time of this chart, if you make it start from 2010, for example, you see how volatile it is. As you can see from this chart, the price of Bitcoin sometimes increases very strongly, which would make investors very happy. But there are some times that the prices plummets very strongly, which would make investors unhappy. So we say that the price of Bitcoin is very volatile, which makes it very risky. Just as a comparison, I prepared this chart. This chart shows euro and dollar parity. The blue line is the euro dollar parity. You see how stable it is as a currency, and you can see the Bitcoin, which is very volatile here, than maybe 40-50 times more volatile than euro dollar parity. And this makes Bitcoin very risky. Even though you can make great money, it is very risky. These are just a couple of examples of technological developments in the financial market, so I just wanted to mention those two. And now let's go back to mainstream finance and then talk about the derivatives. What are derivatives? A derivative is any security whose value is derived from the price of some other underlying asset. For example, Apple future is a derivative who takes its value from the Apple stock. When Apple stock goes up, the investors of Apple future will benefit or will lose money from that increase. It can be used to hedge or reduce risk. For example, an importer whose profit falls when the dollar loses value could purchase currency futures that do well when the dollar weakens. Now let's talk about the importance of financial markets. So why do we have financial markets? Well, for a couple of reasons. The first one is it allows, or if it facilitates the flow of funds from investors to users of capital. That's why markets provide savers with returns on their money on one side, and market provides users of capital with necessary funds to finance their investment projects. So it's a kind of win-win situation. So well-functioning markets promote economic growth just because those guys, those companies who need money will benefit from well-functioning financial market. And economies with well-developed markets perform better than economies with poorly functioning markets. Let me give you an example. Obtaining a legal title to a dwelling on urban land in Philippines involves 168 bureaucratic steps and 53 public and private agencies. And at the end, the process takes an approximately 15 years of time. And the same situation is in Egypt. It takes 5 to 14 years to obtain a legal title to your house. Before I move to stock market, I would like to mention a couple of financial institutions very shortly. The first one is investment banks. Investment banks traditionally help companies raise capital, and they're also called underwriters just because they guarantee that the firm will raise the needed capital. The second one is commercial banks. Commercial banks are the banks you know, like Chase Bank of America. They are all commercial banks which collect deposits from us and lend it to whoever needs. The third one is financial service corporations. They are large conglomerates that combine many different financial products within a single corporation. Pension funds are retirement plans funded by corporations or government agencies for their workers and administered primarily by the trust departments of commercial banks. The fifth one is called mutual funds. Mutual funds are really important. They are corporations that accept money from savers and then use these funds to buy stocks, bonds, or short-term debt instruments issued by businesses or government units. These organizations pool funds and thus reduce risk by diversification. So there might be different kinds of mutual funds. For example, they might collect funds from you. They might invest in green energy, for example, which means that they are going to be highly focused in green energy, or they might be interested in pharmaceuticals, etc., etc. At the end of the day, different funds are designed to meet objectives of different types of savers. Hence, there are bond funds for those who prefer safety, stock funds for savers who are willing to accept significant risks in the hope of higher returns, and there might be money market funds, etc., etc. At the end of the day, they collect funds from you and they invest in an area which is explicitly announced to you. And then the sixth one is called exchange-traded funds. Exchange-traded funds, or ETFs, are similar to regular mutual funds and are often operated by mutual fund companies. ETFs buy a portfolio of stocks of certain type and then sell their own shares to the public. In this example, an ETF is investing in S&P 500 companies, some of which are Apple, Alphabet, Microsoft, and Google. So a mutual fund might form an ETF that invests in the 500 companies in S&P 500 index and sell those shares of their own fund to investors. Thus, by buying that ETF, an investors would have tiny shares of all those 500 companies and practically be investing in those 500 companies at the same time. There are ETFs on various other indices too, as you can see from this chart, and I will explain the details of those indices in a couple of minutes. The last one is called hedge funds. Hedge funds are also similar to mutual funds, just because they accept money from savers and use those funds to buy various securities. They are different than mutual fund in a couple of ways. One of them is they are not regulated by Securities and Exchange Commission, SEC, and they often have minimum investment requirements, generally around $1 million. So if you don't have $1 million, you can't be hedge funds clients. Okay, now let's talk about the stock market. So stock market is generally divided into two categories. The first one is stock markets with physical location, and the second one is electronic dealer-based stock markets. An example of the first one is New York Stock Exchange. NASDAQ is an electronic dealer-based one. These days, as the technology has been improving and developing, physical location stock exchanging are losing their appeal. So nobody needs to be in New York to buy stocks from New York Stock Exchange, so you can electronically buy from anywhere. So let's give an example to cover a couple of issues that I mentioned. Apple Computer decides to issue additional stocks with the assistance of its investment banker. An investor purchases some of these newly issued shares. So the keyword here is newly issued. Is this a primary market transaction or a secondary market transaction? Well, the answer is primary market transaction, just because it is a newly issued share. So you are going to be buying it from the company, the investment banker directly. What if instead an investor buys existing shares of Apple stock in the open market, which means that you will be buying from somebody who's willing to sell it? Is this a primary or secondary market transaction? This time, this is a secondary market transaction because you are not buying directly from company or their investment banker. Okay, now let's define what an IPO is. IPO stands for initial public offering, and it occurs when a company issues stock in the public market for the very first time, and it's also called going to public. Bloomberg offers an opportunity of seeing the recent IPOs on their terminals. To see this, we open a Bloomberg screen and then write IPO here. And then when we click on IPO, it's going to ask us which dates are we looking for. And we should change the recent date to today, which is September 2nd, 2021. I hit enter. On the bottom panel, you should hit most recent one. So here you will see the most recent IPOs globally. So global IPOs are all here. For example, this corporation is going to go public today to raise $100 million, and then comes international, One Career, etc., etc. And then you can see the ones that are already done a couple of days ago. They are all global IPOs, which are recent. So these are already over. These ones are going to be happening today. We don't know the exact amount of fundraise they are going to make today. Now let's see the performance of S&P 500 index from 1968 to today. The blue columns, the blue bars are showing the positive returns. The green ones are showing the negative returns. The return is defined as dividend yield plus the capital gain or loss. So we calculate this as follows. Return is equal to today's price minus yesterday's price over yesterday's price. This is going to be capital gain. And then if that stock gave us a dividend, which is not always the case, we have to add dividend divided by yesterday's price too. And this is going to be dividend yield, and this is going to be capital gain or loss. And this graph shows a performance of S&P 500 index. I'm going to define what S&P 500 index refers to in a second, but for the moment, I'm just showing the performance of that index. Now let's formally define what a percentage return is. A percentage return, which I will call RT, meaning return at time t, is the price at time t minus price at time t minus 1 over t minus 1. This is called capital gain or loss, plus the dividend gain. It is dt over pt minus 1. So if there is no dividend gain, then you can ignore this. This is called dividend yield. For example, just an example, if the price of a stock was $200 yesterday, now it is $220. This is yesterday, this is today. So what is the percentage return? Percentage return is RT is equal to, there's no dividend by the way, price at time t, which is 220, minus 200 divided by 200. So it is going to be 20 over 200, which makes 10%. So this is how we define return. So where can we find the stock code, or what does one look like? Well, there are many sources, but I will show you a couple. One of them is Yahoo Finance. When you open a browser and write finance.yahoo.com, you will go to Yahoo Finance webpage, and then whatever stock you are looking for, just write the name here, Apple, for example, click on the Apple, you will see the price of Apple that day, what percentage of return that stock made with respect to yesterday. And then you can see a couple of details too. What is the market cap, meaning the value of the company, and previous close, and a couple of other details, which I'm not very interested for now. Or the other one is you can use a Bloomberg terminal. If you have a Bloomberg terminal, you write Apple on the search bar and then scroll down using your mouse. You have to go to second panel here, which says securities. The first panel says functions. We are interested in functions. We are interested in securities. Apple is a security. And then click on Apple here. And then it asks you what you are looking for. Currently, I'm going to show you the line chart. At the top of the line chart, you see the Apple stock price for now, right now, $152.79, and the historic performance of Apple for these days, okay, between September 2nd, 2020 and now. And then all price changes are here. And the lower panel here shows the trade volume. This is how we can find stock prices using publicly available and non-publicly available resources. And then we can find the same thing like S&P 500 here too. So if you write here S&P 500, and then when we click on line chart here, we will see the S&P 500, which is 4,528 right now. You can do the same thing on Yahoo Finance too. You can write here S&P 500. Its ticker on Yahoo is GSPC. Click on it. You would see the same exact price on Yahoo Finance. So the question is, what is an index? So how do we define an index? There are a couple of approaches here. To understand those couple of approaches, let's review a couple of mathematical facts. The simple average is defined as addition of all prices divided by n. If there are two prices, for example, the simple average of those two prices is the first price plus the second price divided by 2. This means 0.5 times first price plus 0.5 times second price, which means that they are equally weighted. We are multiplying both prices by 0.5. And those two weights, which is 0.5 and 0.5 in this case, they must add up to 1. In weighted average index calculation, we just change those two numbers. Instead of 0.5, we are going to increase one of them and decrease the other depending on several factors, which I will explain. How do we determine the weights? Well, there are different applications. Let me explain them on an example. Assume, for example, that Apple's stock price is $200, Amazon is $1,800. A simple average index is just like you add those two prices divided by 2 or equal weight them, which is the same thing. The index on Monday, so this is Monday prices, the index on Monday is going to be 1,000. And assume, for example, Apple was $200. The next day, Apple is $250. Amazon now went down. So Apple increased from 200 to 250. Amazon went down from 1,800 to 1,750. So according to this calculation, simple average calculation, the index is going to be 250 plus 1,750 and divided by 2, which is again 1,000, meaning index on Monday is 1,000, index on Tuesday is 1,000 again. So it did not change just because Apple went up by 50 and Amazon went down by 50, so they balance each other. But the interesting thing here is, in this example at least, Apple's market value is $2.2 trillion, where Amazon is $750 billion, meaning that Apple is much more valuable company in this example than Amazon. So equally weighting those two companies might not make sense. So that's why people came up with this idea. Everything is the same. Now I'm going to weigh them by a different number instead of 0.5. So what is the approach? The approach is this. Take the Apple's market value, which is 2,250,000,250. So this is wrong, I'm sorry. And then divide it by the total value of the market. So total value of the market is Apple plus Amazon. So total value of the market is 3 trillion. Apple's market value divided by total market value gives the Apple's weight. Amazon's market value divided by total market value gives the Amazon's weight. Okay, let's do the calculation. For the first case, which is Monday, Apple's stock price times Apple weight, Amazon's stock price times Amazon weight will give you 600. So second index on Monday is 600. Now let's look at Tuesday. Apple's stock price went up by 50 and Amazon's stock price went down by 50. And will they be balanced? No, as you will see, just because they will not be equally weighted. Apple's weight is going to be larger, so Apple's increase will be much more powerful than Amazon's decrease, as you will see here. So Apple times Apple weight, Amazon times Amazon weight, when you make this calculation, the index is going to go up. Bottom line is this. We made two index calculations. The first index, which is simple average. The first index is simple average. Monday, the index is 1,000. Monday, the index was 1,000. And Tuesday, the index is still 1,000, meaning that there is no change at all in the index. But the second index, which gives higher weight to more valuable companies, which is Apple in this case, Monday's index is 600. And Tuesday's index is 625, which basically shows you that the market is up. So there's 0% return here. Here it is a positive return, which is 4.2%. Now let's take a look at a couple of indices from Bloomberg. We can do the same thing from Yahoo Finance. In Bloomberg, you just write here the name of the ticker, the name of the index, which is S&P 500, or just like click on it. So this is S&P 500 index, which is market value index. So remember my second index example, that was approximately the same methodology used by S&P 500. So this is S&P 500 index. When we click on edit chart, we can add Dow Jones Industrial. Dow Jones Industrial is not using market value as a weight. They are using the price as a weight. And we can add NASDAQ. As you can see, they're approximately following the same trend. We can normalize them from here, making them start from 100 all. So for the last 1 year, all of these three indices, if we assume that they started from 100, they made approximately 20-25% of return, as you can see from the right-hand side of the chart. But we don't need to normalize them, of course. If you don't normalize them, you can see the real index numbers. So the blue one is Dow Jones, the white one is S&P 500, and the orange one is NASDAQ. So let's take a look at the white one, which is S&P 500. It started somewhere around 12,000. As of today, it is 4532. S&P 500 is created in 1926, and it's widely regarded as the standard for measuring large cap United States stock market performance. It is weighted by each stock's market value, as I said, so the largest companies have the greatest influence. So the bigger the company, the higher will be the weight on the index. This graph shows the market value of 10 largest stock exchanges by 2018. As you can see, New York Stock Exchange, which is the largest stock exchange in the world, had a value of almost $21 trillion here. And NASDAQ had $9.8 trillion as of 2018. In 2020, the situation changed a little. The value of New York Stock Exchange has climbed to almost $22 trillion, and the NASDAQ jumped from $9.8 trillion to $19.1 trillion, just because NASDAQ has acquired a couple of stock exchanges, some of which are Philadelphia Stock Exchange and New York Stock Exchange. So that's why its value has increased to $19 trillion. Well, after this much of introduction, let's ask a very crucial question. Is it possible to make money in stock market by just like evaluating and studying stock prices? Well, to answer that question, we should define market efficiency. Well, what do we mean by market efficiency? When we say a stock market is efficient, we mean that the securities are fairly priced, meaning the price we see on our charts, on Yahoo Finance, on Bloomberg, they are approximately equal to intrinsic value. What was intrinsic value? Let's remember from the previous chapter, chapter 1, a stock's intrinsic value is based on its expected future cash flows and its risk. So if a stock price is approximately equal to intrinsic value of the stock price, there might be ups and downs, little ups and downs, of course, but if they are equal approximately, this means that stock market is efficient. Again, it means that investors cannot beat the market except through good luck or better information. Just because everybody has the same information set, same information about the stock markets, if there is an instantaneous anomaly, somebody would immediately realize it and that anomaly would disappear. Let me tell you a joke about this. An economist and a normal person are walking down on a street together. The normal person says, hey, look, there's $20 bill on the sidewalk. The economist replies by saying that that's impossible. If it were a really $20 bill, it would have been picked up by now. Okay, he is referring to an anomaly. If there's an anomaly that which is $20 bill lying on the sidewalk, somebody would immediately realize it and it would immediately disappear. Efficient market hypothesis is saying, in fact, two things. The first one is nobody can beat the market except by pure luck. And the second one is there cannot be any asset bubbles in the market, just because if there is an anomaly, somebody would immediately realize it and it would immediately disappear. This much of information, in fact, summarizes what efficient market hypothesis is. But in the next video, which is recommended, not required, I would briefly detail the stock market efficiency. Okay, so the question is market efficient? There are a couple of reasons that markets may not be efficient. First of all, it's very costly or risky for traders to take advantage of mispriced assets. If there is an anomaly, sometimes it's very costly. There are a couple of cognitive biases that cause investors to make systematic mistakes that lead to inefficiencies. This is an area of research known as behavioral finance. Behavioral finance borrows insights from psychology to better understand how irrational behavior can be sustained over time. For example, overconfidence is one of the irrationalities that we see investors have. So what is overconfidence? Overconfidence is the difference between what you actually know and how much you think you know. Just a couple of real life examples. 84% of Frenchmen feel that they are better than average lovers. And then 60% of Swiss people claim that they are in the 20% quintile of best drivers, which is impossible. 60% of the society cannot be rationally, mathematically be in the 20% quintile of the best drivers. These examples are showing that we, from time to time, exhibit overconfidence, which makes us think that we are better than other people. And then, so what is the consequence of overconfidence? One of the consequences of overconfidence, researchers say, is that people overtrade because they think that they have superior knowledge and skill on trading than others. So they think that they are better than others. That's why they start trading every single day, which make them sometimes lose money. In this chart, you see the evolution of behavioral finance. Behavioral finance mainly emerged at the end of 1980s. Mainstream finance scholars are saying that markets are efficient. On this chart, you see the number of papers written, and in time, number of papers, academic papers written in efficient market has been decreasing, and the number of papers written on behavioral finance has been increasing, just because behavioral finance seems to explain the irrationalities in the market better than efficient market hypothesis. So this is all about chapter 2. There's a video about efficient market hypothesis, a detailed video, which is not required, of course, but recommended. You can go ahead and watch that video if you wonder more about behavioral finance and efficient market hypothesis. Okay, thanks for watching this video, and I hope to see you in the next videos.